is a date that is out, that they have set. You know, this is the time frame at February 22nd, tomorrow. Everybody that owns a share gets a dividend. Everybody that doesn't, if you don't have one, you don't get a dividend. So that's the date of record there. For the accounting purposes, we don't, it doesn't matter to us. It just matters to who's getting that money. But for our accounting, we're still going to have, there's no requirement to put anything in there as part of that. And then finally, there's a time that we do pay that. When that down a month later, we're going to pay this dividend, then we have that journal entry. So we're going to take a look at that, each of those times in here as we work on this. All right. So we have, so we're doing the declaration, that's commitment to pay, the record, the payment dates in connection with the cash dividend of $135,000 of the corporation's common stock. And those dates are January 12th, March 13th, and April 12th. So we're going to journalize each of those on each of those days. So the first one is January 12th. We now have a commitment to pay. Oops, I should have done all that on this one. I thought I made my copies. Sorry. Let's fix that. All right, so January 12th, start that over again. We have committed a cash dividend that we're going to pay. So remember dividends. So if you look at the front of your book, a dividend is typically a debit. It tells you that here. If you look at this chart here, it tells you that it's a dividend. The debit, you need to increase that. So that's what you're going to do here. It also tells you in the back of the book there too. That's where it is. All right, so we have a cash dividend. Remember, there are also stock dividends too, which is they're giving out stock as a part of that, which is different. We have $135,000, and then we have cash dividends payable. So now we have to accrue that liability because we made that commitment. All right, so on March 13th, this is the date of record. Remember what I said about the date of record? It doesn't really matter to us, so there's no entry required. So in there, please make sure that, I believe in Cengage, you need to check that off and find out the drop down. Or type that in, no entry required. Yeah, so just make sure you put that in there. Don't leave it blank for that date because it will deduct points from you. So please make sure you do that.
So reading this, the declaration is January 12th.
Yes.
The record is March 3rd. The
Yes.
payments are.
Yes.
Got it.
So it's just an order right there.
Okay.
So let's go to the April 12th date. Okay. So we have cash dividends payable. We owe that here. And then we're going to pull it right out of cash. And that's $135,000. And that is what you would do as your journal entries. I'll make that a little bigger for everybody so you can see it. All right. So again, commitment to pay, declaration date. We accrue that liability. Get a record. Doesn't matter to us for our side of that. Obviously matters to who's getting the money. And then on this side here, we actually pay that dividend. And as a part of that, a side note, not all companies pay dividends, but there's quite a few companies do, especially existing companies that have been around a long time. Those that have not been around, a lot of times will use that money that they made to reinvest in the company and grow the company. Ones that have been around a long, long time, like Procter & Gamble, they pay a really good dividend. So those type of things there that be a long time. So what they do is sometimes they'll take that money, give that dividend, and even use some of that retained earnings to buy back stock as a part of that. That's that treasury stock that you remember.
which don't pay dividends, right?
Yes, because you don't pay interest because you own it. So you're not
Right.
paying yourself as a
Okay.
company, yeah. All right. Any questions at all? Let's jump to 12-6. And so this one. Now we're jumping into the bonds chapter. So remember what bonds are? They are debt. So in chapter 11, we looked at equity, as in that's how we raise money, is we sell parts of the company. On this side, this chapter, now we borrow. That's what bonds are, basically debt. So people buy corporate bonds, and actually that went up a lot last month. It increased quite a bit, corporate bond buying. So 12-6, that is on page 473 of the book. So let me copy some of this over. All right, so it doesn't give us any dates here. It just tells us to generalize things. So let me go and read through this here. I want to stop and say what we need to look at here. So the first day of the fiscal year, parent company issued at $18,500,000 of a 5-year 10% bond to finance its operations of producing and selling home and improvement products. Interest is paid semi-annually, so remember it's twice a year. So we need to figure that out, calculate that. So basically, what we're paying on that is 5% per time. As a part, that's half that. The bonds were issued at market interest rates of 12%, resulting in receiving cash of $17,138,298. Now, what you'll see, there's a difference between the two. So we have, it's quite a big difference. As a part, that's about $1.3 million, almost $1.4 million. The reason being is that if I can get 12% out there, why would I buy your bond? If I can get somebody else that can pay me 12% out there, and I'm going to only get paid 10% from you, so you have to entice them with a discount. And so that's a reflection of that. So that's why it's different. And so if ours was higher, let's say ours was 14%, and theirs out the market rate's 12%, then we get a premium on that because I'm paying way more than everybody else is. So therefore, that's the difference between the two, as you're learning about that in chapter 12. Hopefully that clears things up a little bit on that. All right. Let's take a look here. So we get cash in. Just up to the top here. So we get cash in as a part of that. And then we have bonds payable. Now, our bonds payable is still the same. It's supposed to be the 18.5. That's good. And then we have our cash, which is at 17,138,298. Those of you that are considering moving it forward in accounting, we actually calculate all these things. Present value tables and those type of things. So this is things we actually calculate. And here, right now, it's given to us. So we just dig a little deeper, we go into that, talk about bonds, and then you amortize those over time by how much that discount goes away. And essentially, you're getting as a discount. So, discount on bonds payable. And so that discount is the difference between these two here. So questions there at all? They didn't give us a date. Yeah, so otherwise, yes, I put the date in there, but they just said the issuance of that, whatever it was. So that was the issuance of the bond, that was number one. So what I'll probably do is I'll just insert it here real quick. And make sure this is part one. So we have that. So let's look at here. So part one, this will be part two. So on number two, then it says, first semi-annual interest payment. The bond discount is combined with the semi-annual interest payment. All right. They're gonna probably do the discount of bond over the whole length of time, straight line. Where typical stuff, we don't do that, we'll amortize that over a little bit of time, so that's great. But we're making it simple, which is good. All right. So we have interest expense. And then we have our discount. Just copy that. So discount bonds payable. Now remember, we're taking, how many years was this? So there was 5 years. That means we have 10 payments of that. So basically I'm gonna divide that by 10, okay? So I'm gonna take this number here and then divide that by 10. Because we have 10 payments of that, 10 payments of that. Yeah, 5 years, twice a year, 10. So you'll see the formula in there for that, so that way you can reference back to what we just did there. You get that. All right, so I don't know my interest expense yet. All right, so then I have a cash outlay as a part of that. So, what am I supposed to pay cash on? So to calculate that cash, what we're going to do is basically, I have the 18.5 million. It's 18.5 million, and we're supposed to pay 5% on that, right? 10%. Those 10%, yes. 5% for that portion of that. So basically what you can do is this. This is how I recommend doing this, is taking the 18.5 million times 10%, and then multiply that by 1/2 or divide by 2 either way. And then you should get your, what you would pay as that. Because remember, you're paying on that interest there. So let me do that here. I want to divide it by 2 since we do 2.
Dividing it by 2 because there's a semi.
Yes, yes,
Okay.
it's twice a year.
Right.
Or multiply by half.
Right,
Either way,
right.
yeah. And so my total interest expense is these two combined. And why do we do that? Let's do that over here. All right. Questions on that? Pretty simple there. So let me do the third one, second semi-annual payment. We're going to round to the nearest dollar, it says. Basically, it's the same thing. Because we're doing it just straight line, we're doing the interest. We're not calculating the effective interest. Again, those who are moving on, you do that. But for here, it's going to be simple right now. So I'm basically going to copy and paste this and make this straight. But it's changed. Formulas. Oh, that's right. Do that. There we go. All right, questions on that part? Pretty good? All right, so that's the first portion, that's your A. Let's see what would be here. So determine the amount of the bond interest expense for the first year. All right. So let's calculate that. So this is part B. So as a part of that, so we have an annual interest paid. And so my annual interest paid is that number, the 925, multiplied by 2, right? Because you're paying twice, which is basically 10% of our original amount. So it should be 1,850,000. But I'll just put it in here this way. So this plus this. Let's not do that. All right. So then we have our plus our discount amortization. So I have both of those. This. That will give me my interest expense for the first year. And we'll put line underneath this, and then we'll sum this up. Awesome.
So annual interest paid, I would have thought that would have been the interest expense.
It would seem like it would be. We amortize the discount as a part of that, so we're trying to get rid of that discount that we have there. So yes, we pay this interest, but we are basically collecting some more because of the fact that we didn't get as much money in the beginning.
Okay.
So that's why that's there. So it actually pulls away from our income on the back end of that as a part of that, because we actually lost a little bit because they weren't able to. We're paying. We're going to have to pay off that $18,500,000. We only got $17 million.
Okay.
So that's the difference there. So we're going to pay off it. Yeah. All right, this is the last part of the problem. It says explain the company was able to issue the bonds for that rather than the face amount of that. Again, what I said earlier, the difference between that is because the require, if they can get a higher rate of interest, they're going to choose that. So as a part of that, we have to discount ours. So that way it's to the fair market value as a part of that. So we discounted certain amounts. Questions on that at all? All right, the last problem we're going to go over here is BX 14-2. So put the wrong one. Is anybody taking that test? It should be 14-1. Actually, let's do 14-5. I'll make an adjustment there. Yeah, I'll make an adjustment in there. Hopefully, we'll get that test. So I'll make an adjustment there. So that should be the number there. It'll be 14-5. It'll be similar to this one. So let's take a look at that. All right. So in this problem here, we are going to calculate the statement of cash flows using the indirect method. Now, there's a difference here in both these methods. The first method is there's two methods. Direct method, which is preferred by the FASB. But basically, it's a little harder to get the information as a part of that. It's a lot simpler to use, a lot easier to figure out. Basically, what cash comes in, what cash goes out. Cash received from customers, cash payments that you make out there. It's simpler in that way. Now, in the indirect method, we have to kind of do a few different things. We start off with net income, and then we take away any depreciation or amortization. That amortization was something like we had for the last one there that we have there. So those are things that you take out of there, and then you take the changes in your assets and liabilities. So your current assets and current liabilities, and what's changed as a part of that. So if I have a prepaid asset, let's say prepaid insurance, a lot of times we may prepay that. If I have an increase in that, well, that kind of works in the opposite, because if I have an increase in prepaid insurance, that means I had to use some cash to pay for it, right? And so that's why we will actually take it away and decrease as a part of that. So it works in the opposite way as a part of that. Where if I actually didn't pay my bill, my accounts payable went up, that's a positive thing in the cash flow sense. Obviously, it may not be a good thing in our credit if we're not paying our bills, but in that sense of cash, I still have my cash in my pocket. And so that's what you want to do is when you look at this chapter is how does it affect cash? And that's all you want to think about. Not really, did I make money on that deal or did I not make money on the deal? How did it affect my cash? So when I sell an asset, like this building, let's say it's worth $1 million and we sold it for $700,000, well, that's a positive cash flow, but I lost $300,000 on the thing. So that's not a good thing for that sense, but you get me $700,000. So that's what, so remember that as you're looking at this chapter here, especially since this is the last chapter you're looking on. It's a part of that, so I hope that makes sense. All right, so let's take a look here. So again, we start off with net income. All right, so with net income here, it tells us that we have $400,000 in net income. So I have my adjustments to net income. Remember that goes into my depreciation. And those are the things we're going to start off with first. So typically depreciation is one that you're going to see. I don't think we do amortization very much. Probably want to see it the test, but just be aware of that. So depreciation there, it tells us that we have depreciation recorded on store equipment for the year amounting to $16,000. So what we do as a part of that, we add that back in. Okay, so that's a positive number. Why? Well, depreciation, we take depreciation on it, it's a tax benefit that we get. There's no cash transacted, right? We don't pull any cash out to pay for that depreciation. We just take the tax benefit of it. That's why we add it back in, because it's a positive to our cash because we didn't touch it. So we need to put it back into it. Because our net income reflects us taking it out. All right. So now we're going to do our changes to our current assets and liabilities. I'm just going to hold it. All right, so I'm going to go down the list here. So cash, so at the end, one of the things you want to check for on the exam is to make sure that everything balances out. So that your ending cash is your ending cash, what it's supposed to be, as a part of that. So make sure it balances out, especially in this chapter, as you're working on some of that stuff, make sure that it balances what it's supposed to be. So we skip cash as our current asset because that's what we're calculating. So we're going to skip that portion there. So let's move our way down. So we have accounts receivable. I went from the beginning of the year, I went from 28,000 up to 30,400 in this problem. So I went up $2,400. So if my accounts receivable went up $2,400, that meant I didn't collect my cash. I didn't collect from my customers. So therefore, I don't have cash. So that's why we are going to actually take it away. So I have the increase in accounts receivable, but it's going to be a negative number. All right, the next one is merchandise inventory. I went from 44,000 to 40,000. So I have a decrease in merchandise inventory. All right, so that's it. What that means is that I'm adding that back in because that means I used some of my existing inventory. And so I didn't pay any more cash for anything else. I used some of what I already had. Therefore, I already reflected some of it in my cost of goods sold, but I used some I already had, so therefore I didn't pay cash. So I'm going to add that back into it. I did pay cash at one point, but let's previous year. All right, next one is the increase in prepaid, excuse me, yeah, there's an increase. Okay, increase in prepaid expenses of $1,200. So that means I spent some extra money paid some of the expenses early. Questions on that? All right, so now we're going to go into our liabilities here. So in my liabilities, I have accounts payable, and these are the merchandise accounts. I have an increase in that from 36,000 to 40,000. So increase in accounts payable. That's a $4,000 increase. That's a positive. That means I didn't pay my bills, or a bunch of my bills that were cash. Yeah, so I still have the cash for that. All right. Now we're going to do a decrease in wages payable. Oops. Capitalize that. All right, so I decreased my wage payable because I paid some of that. Therefore, I'm less $2,800 as part of that. All right, so let's grab one of my net cash flows. Oops, cash and clash. All right. So my net cash flows from operating activities, 478,600. All right, that's good. Depends. We want to look at references as part of that. We want to see. So when you're looking at cash flows for companies, you want to see a lot of the cash being generated out of your operations. You don't want to see it investing. You should, because that means you may be selling assets to make sure you have cash. Or you don't want to see it financing a lot. And when you're growing and starting up a new business, you will see it. So as you see, as a business has been going on for a while, if you start seeing them start getting more and more in their financing and money going out, there's not a lot in their operations, big red flag. There's something maybe going on. They're having to support their operations by getting money in other ways. And so that means through financing, which is bonds, or through equity, so part of the company. So remember you have the three categories. You have your operations, and we just did that part there. And you have your investing, which is the fixed assets that you have. So buildings, equipment, those type of things that help support that operating activities. And then you have your financing activities, which is how you acquire debt or sell portions of the company or different things like that. You'll see some companies actually will buy back a lot. So the example I gave you in Procter & Gamble, they gave out dividends. They gave out $8 billion dividends last year. They also purchased $8 billion worth of stock back in as treasury stock as a part of that. So that shows strength. It shows strength as a part of that. So that's what you want to see as a part of that. You don't want to see other things than borrowing money and those type of things there. But it's not always bad because there may be reasons why they're doing it. It just gives us a chance to look at the reason though, why that is. Because maybe they're borrowing a lot of money because they're expecting to expand quickly. And they're setting themselves up because cash, when you have cash, you have the opportunity to do a lot of different things. So a couple of years ago, Apple decided to get lots of debt, even though they were one of the cash richest companies in the world. They said, well, that's cheap. We'll just get some more because we're going to make some other plans and do some more research and development and continue to build. And so that's what their plan was to do. So it's still not always bad, but it gives us the opportunity to look and see in different areas. All right, so those are the 7 questions. I went through them all there. I will have this posted on Canvas right when this finishes up here. I will try to get that thing posted also, the video, so that way you have all of this information as a part of that. So remember, this is on 7 chapters, 7, 8, 9, 10, 11, 12, and 14. Those are the 7 chapters. This exam will not be on the first 6. All right, and I will open up so you guys can see what you missed. First 6, I didn't realize you guys couldn't see that. Those of you that are watching too, there's been some issues with Cengage, and I want to make sure I fix all of those things tonight. I'm going to have to manually basically put in everything. I don't know if everybody saw that it kind of disappeared. So all your chapters 1 through 6 grades have gone. Those of you that had some, they're now gone. So I'm going to go in and fix all of that manually as a part of that. So I should be hopefully done tonight. It'll probably be close to midnight or more before I get it done. I'll see if I can get that. So, questions on anything? You guys want me to go over anything else?
There was one, oh my gosh, this took me half a day, and I still didn't figure it out, was chapter 11. I
Okay.
can't remember it was where you're figuring out the dividends for years. The par and per common stock dividends for like years 1, 2, and 3, and then you had to write how much your each share was and how much. I know that in 11, the last column was, that's what it was all about.
Okay.
It was the last column in chapter 11. But it talked about figuring out the per share and then common share dividends for each year.
Okay. Let me pause this real quick, and then I'll take a look at that. You guys have a question on that too? You want to take a look at that?
No,
Or?